Alright, let's talk about something that sounds super complicated, but maybe, just maybe it isn't. The stock market. I know. It sounds like a place where men in expensive suits shout numbers at each other while staring at blinking green and red lights, and sometimes it is. But the basic idea is actually something you see every single day. You go to a coffee shop, you order your latte, you pay your money, they give you the coffee. It's a simple exchange, right? You wanted coffee, they had coffee, a deal was made. Now, what if instead of coffee, you could buy a tiny piece of the entire coffee shop? That's it. That's the stock market in a nutshell. So, why should you even care? Bills to pay, shows to binge watch, maybe a plant you're trying to keep alive. Fair enough. Understanding stocks is like knowing the difference between renting an apartment and owning a house. Both give you a place to live, but one gives you a stake in the future. It's about a tool that can help your money work over time. It's about giving your future self a high five. Ignore the bulls, bears, tickers, shorts, the strange zoo. We'll break it down with things that make sense, like pizza. Everyone understands pizza. It's round, it's delicious, and it explains owning a piece of something big. Not magic, just a system. Very big, very fast, sometimes very dramatic, but a system nonetheless. Think of this as your friendly guide. No shouting, no expensive suits required. Unless you want to. You do you. Let's get right to it. What is a stock? Imagine your favorite local pizza shop, Pete's Perfect Pizza. Pete makes incredible pizza. So incredible he wants to expand, open more shops, buy a bigger oven. Maybe even a fancy delivery car, not his 1998 sedan. But all of that costs money, a lot of money. Money Pete doesn't have lying around, so Pete sells ownership piece by piece to raise cash. Each piece is a stock, a share. They mean the same thing. When you buy a share, you become a part owner, a very small one, but still an owner. You can't just walk into the kitchen and start throwing pepperoni, but you do own a slice of the business. If Pete does well, opens new stores, sells more pizzas, makes more profit, the whole company becomes more valuable. What happens to your slice? Its value goes up too. Maybe you bought at 10. Now demand pushes it to 15. This is why companies sell shares, raising capital to fund dreams, innovate, build, hire, grow, without a giant bank loan. In return, they give up some ownership and share future success with new part owners. It's a trade-off. When people own stock in big brands, it's the same principle. A tiny fraction of the company. They believe the company will do well, create amazing products, make money, and as it grows, so should the stock. You're not buying a random code, you're buying a piece of a story, a brand, a future, a very small piece, but a piece all the same. And sometimes, small pieces can grow into something pretty big. Okay, so you have companies selling slices and people wanting to buy. Where do they meet? They can't just bump into each other on the street like, "Hey, you selling a piece of that tech company?" "Why, yes, I am." What a coincidence. No, it doesn't work like that. This is where the stock market comes in. A giant, organized place for buying and selling, like a farmer's market or grand bazaar for shares. Exchanges like the New York Stock Exchange and NASDAQ. It used to be shouting and paper, now it's mostly digital. Same principle. A centralized place for fairness and transparency, where buyers and sellers are matched at an agreed price. So what makes a price go up or down? Supply and demand, an auction happening millions of times a second. Good news, suddenly everyone wants a slice. Lots of buyers, few sellers, the price goes up. Bad news, everyone sells at once. Lots of sellers, few buyers, the price plummets. That zigzag chart is the push and pull. The price is simply the last price someone was willing to pay. It reflects information, hope, fear, the collective mood. And that mood can change fast on news, rumors, or just a feeling. That dynamism makes the market exciting and a little terrifying. So you've decided you want to buy a slice of that pizza company. How do you actually do it? You can't call the CEO and say, "1 share please." You need a broker, your personal shopper for the stock market. Today, it's usually an app or website. Open an account, put money in, and place orders to buy or sell on exchanges. Brokers provide a service and often charge. Sometimes a fee per trade, other times more subtle ways. Be aware, small costs add up. Always read the fine print. Nobody likes a surprise fee. It's the financial equivalent of finding out guac is extra. Some companies share profits with owners. It's called a dividend, like Pete having a great year and handing some cash to shareholders. For each share you own, they might pay a small amount, say 25 cents per quarter. A thank you gift for investing. Not all companies pay dividends. Younger, fast-growing firms often reinvest to grow faster. Different strategies, neither right nor wrong. Here's the key. Risk. The value of your slice isn't guaranteed to go up. It can, often does, go down. Competition shows up. Tastes change. If the business does poorly, your share can drop and you could lose money. That's the trade-off. Higher potential rewards come with higher risk. It's not a savings account, it's an investment with real possibility of loss. Investments go up and down. The goal isn't to avoid every dip, it's to understand what you own and why you own it. Let's talk about the two worst investors in the world, fear and greed. They've lost more money than bad businesses ever could. When markets soar, greed whispers, buy more. Then a drop hits, fear screams, sell everything. You buy high, sell low. Ouch. My friend Dave piled savings into one hot stock at the peak. Bad news hit, down 40%. Panicked, he sold at the bottom. Then the company recovered and hit new highs. If he'd closed his eyes and gone for a walk, he might have profited. The market is a yo-yo on a person walking uphill. Don't fixate on the yo-yo, diversify and think long-term. Start small and broad. Index funds like the S&P 500 give instant diversification at low cost. Sampler platter, not a single gamble. Investing is a marathon, not a sprint. Basics, patience, diversify. Take a breath. You've got this.